This is the Asia Trade. I'm Paul Allen in Sydney, where markets have just opened.
I'm Haidi, Stroud-Watts. The top stories this hour. Asian stocks are set to extend Wall Street losses as trade war and inflation worries come roaring back. President Trump announcing 25% tariffs on all cars imported into the US beginning next week.
The president also hinting he may lower tariffs on China to secure support for a US sale of TikTok.
We will be getting reaction live from the Boao Forum in China, where a PBOC advisor tells us exclusively that Beijing is ready to step up stimulus if growth loses momentum. Well, trade tariffs top of mind yet again for this Thursday session. As we open up in Asia, we are looking like Asian stocks will be resuming that sell-off after a couple of days of moderate optimism that perhaps we would see sort of some exemptions or some sort of narrower scope when it comes to these tariffs. But that sell-off expected to kick off again with uncertainty over the trade policy. We're seeing equity downside indicated for Australia as we get online there. Japan and Hong Kong also pointing to earlier losses. Dollar yen now past that 150 level, which is sort of one thing that we're sort of monitoring from the BOJ and from FX regulators there in terms of how much we see a move in the yen that has just been creeping towards that threshold, really being refreshed as we heard kind of the BOJ's word also sounding quite dovish in his testimony yesterday, Paul.
Well, let's take a look at how US futures are tracking, seeing a little bit of weakness there, and we saw US stocks sinking again on tariff uncertainty. So S&P futures off by a third of 1%. There. Crude prices ticking up a little, even though we've got crude inventories falling by the most since late December. But take a look at these automakers after hours. Ford, GM, Stellantis, all falling following that announcement, although we're seeing a little bit of positivity for Rivian and Tesla there. We were kept waiting for it, but President Trump did eventually give us the news on those auto tariffs. Here he is speaking at the Oval Office.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
Let's bring now our White House correspondent, Kayla Gardner, who joins us in Washington. Also our Chief North Asia correspondent, Stephen Angle, who's on the ground at the Boao Forum in China, in Hainan, as well as our Bloomberg Markets Live strategist, Mark Cranfield, joining us out of Singapore. Kayla, let me start off with you in terms of exactly what we heard from President Trump and, you know, the contours of what we're now expecting in terms of these latest tariff announcements.
Yeah, well, the president signed today a proclamation imposing a 25% on automobiles as well as parts that are not made in the U.S. There are some exemptions for Canada and Mexico prices, but they're saying that they expect this to bring in about $100 million in new revenue to the U.S. They're expected to go into effect, on April 2nd, and they will start collecting that revenue on April 3rd. But this is really part of a very aggressive campaign by the president and the White House to really tariff other countries. And the president says that he believes other foreign nations have been treating the U.S. unfairly. And so he's going to continue with these sorts of tariffs. He also talked about today pharmaceuticals. And so that's certainly an area that we're going to be watching to come up next.
We also heard from President Trump talking about, well, there might be a carve-out for China when it comes to the potential sale of TikTok in the U.S. Let's have a listen to what he had to say.
I'm worried about our country more than anything else with respect to TikTok. And China is going to have to play a role in that, possibly, in the form of an approval, maybe. And I think they'll do that. Maybe I'll give them a little reduction in tariffs or something to get it done.
Well, the deadline looming for the TikTok sale, Kayla, do we have any idea of what potential reduction could be in store for China?
Well, the president was actually asked about that by our colleague who's actually sitting in the booth with me right now. But she was asking whether that the U.S. is confident that they'll be able to meet this deadline next month for the sale of TikTok. The vice president, J.D. Vance, is the person really leading those negotiations on behalf of the White House, talking with various companies about a potential avenue to sort of buy the app or potentially do a U.S. spinoff of the app. And the president floated a reduction possibly in tariffs. He said, quotes, "That sounds like something that I would do," but he did not give any specifics, but certainly teasing the Chinese officials for this possible deal.
NORAD White House correspondent Kayla Gardner there. Let's get to the BOA Forum now, where tariffs have obviously been a hot button topic. Stephen Engel joins us there with more. Steve.
Yeah, obviously tariffs are on everybody's lips. I will actually be moderating a panel later this morning on the global economy. Pretty broad subject, right? But I'll guarantee you tariffs are going to be a large part of that. Included on the panel will be the former Deputy Managing Director of the IMF and former Deputy PBOC Governor Zhu Min, among others. And we will be delving into the impact, obviously, of these tariffs. We're going to be talking to Stephen Roach as well coming up in the next half hour, the former, of course, Asia Pacific chairman of Morgan Stanley. He's been outspoken here at BOA, saying some of these panels are pretty complacent about the risks to globalization and the risks that the tariffs possibly could pose on the U.S. and global economy. So we are going to be delving into that on pretty much the last full day here at BOA, where we were going to get the plenary session speeches, including from the vice premier. No top leaders, not Xi Jinping, not Li Qiang, but vice premier will be giving the opening, well, opening is sort of the closing, isn't it? Plenary speech later today. We also yesterday spoke to a key PBOC advisor, a noted economist, Huang Yiping, who said essentially the Chinese economy is showing signs of strength in the beginning part of this year, which will help them navigate through these tariff chaos. Here's Huang Yiping.
The government has made it very clear that if there is a need, both the fiscal policy and the monetary policy can step up. That, I think, is very clear. So basically, it will be data-driven. If the economy is strong, then perhaps we can just go with it. But if the economy shows signs of softness, then both the fiscal and the monetary policy still have enough scope for further expansion.
How would you assess it right now, coming out of the National People's Congress? There seemed to be a lot of talking about green shoots of confidence, but the property market in the first couple of months was still quite weak. Consumer demand still quite weak. And they didn't necessarily announce specifics on easing or further large fiscal outlays other than long-term bonds and the like. Yeah. Do you see right now the need for further easing?
Well, I think that we need policies to be ready if we need. As I said, it's a data-driven decision. But what we saw was after the end of September last year, the policies turned around and the numbers picked up. So the fourth quarter was much better than the third quarter. If you look at the high-frequency data for the first couple of months, I think we actually had a reasonably good start. Obviously, we needed to prevent replay of what happened before, that is the second quarter and the third quarter weaken again. And on that, I think the readiness of the fiscal and the monetary policy to support the economy would be very useful.
In the first Trump trade war, we saw, I don't want to use the term weaponization of the yuan, but we did see the weakening of the yuan, some 11% over 2 years. This time, the PBOC has kept it very steady and stable. Is that sort of weakening the overall easing buffet that is at their stable? Should they weaken it further?
Well, there are many different arguments. If you weaken the currency, that might be useful in the short term for exports. But at the same time, as you know, exchange rate also has a big impact on the capital flows. It has an impact on trade flows, but also on capital flows. I think for the policymakers, you have to balance, trying to weigh which is more important. If the currency is weaker, and hopefully if it gets lots of exports, then it's good. But it's possible that you might not get a lot of exports while you weaken the confidence on investors. So I think, in my view, is that, our exchange rate is still managed afloat. So management is still part of it. At the end of the day, you need to balance the likely impact on different parts of the economy.
What do you think the policy response so far to the external shocks? Has it been successful enough? We don't know what's coming on April 2nd. There could be further tariffs. Is China going to be able to weather this external shock?
Well, China will be able to weather the external shock. The question is how big will be the shock. But that's also in line with the policy direction going forward. Exports will be important, continuously to be important. The question is, can China continuously rely on exports to drive Chinese growth? That's why the priority actually now is more on expanding domestic demand, particularly domestic consumption.
So we are looking to April 2nd here in China to see if added tariffs will happen on China. And again, on that TikTok concession, if you will, that Donald Trump alluded to, that might not necessarily be agreed to by China, because so far China has not budged on the sale, the demanded sale by the United States of TikTok to a U.S. investor.
Our Chief North Asia correspondent Stephen Engel there at the Boao Forum in Hainan. Meanwhile, St. Louis Fed President Alberto Mussolem says it's not clear the impact of these tariffs will prove temporary. He's warning that secondary effects could prompt officials to hold rates steady for longer.
I would be wary of assuming that the impact of tariff increases on inflation will be entirely temporary, or that a look-through strategy will necessarily be appropriate. I would be especially vigilant about indirect second-round effects on inflation.
Let's bring in for a markets view, Mark Cranfield now. It is difficult at this point, right? There seems to still be a pretty steady camp in markets that assume that the Fed is going to be able to stay the course.
Well, bond traders are already making up their mind on that one by steepening the yield curve. So clearly what is happening here is that people who invest in particularly long-term treasuries have already decided, exactly as the Fed speaker was saying, that the risks are to the upside for inflation, that it will stay in the system for much longer than the Federal Reserve is hoping for. Now, that may well mean that the Federal Reserve at some point this year is able to lower short-term interest rates. We do have 2 rate cuts priced in the Fed dot plot that was released last week, but there's not much the Fed can do about long-term yields. That's really in the hands of the market and how they feel the long-term inflation aspects will play out. And for now, most traders are thinking that the effect of tariffs over the next several months going into next year will keep the CPI numbers a bit higher than the Fed is comfortable with. Now, the Fed have also said, in some of the people speaking recently, that they're willing to look through temporary changes in inflation. Well, the market is beginning to decide, as you just heard there, that this is not a temporary situation, that the trade war is going to be there for some time. It's not just about what the US is doing. It's also going to be the responses from other countries as well. We've already heard today from Canada's Prime Minister that he's not happy about these auto tariffs. I mean, we're expecting to hear from the Europeans later today. It's the middle of the night now, but when they do, they're also going to be on that side. So it's a two-way street, and that means that globally, inflation is likely to stay higher for everybody, and it will be reflected in steeper yield curves. The Treasury has got a long way to go yet. The curve is only modestly steepened. It could do a lot more. It's also going to affect what happens in European bond yields and even those in Asia as well. So what we see in the Treasury market is one of the clear indications that investors expect this trade war to go on for quite some time.
Yeah, and another shot fired today, Mark, in terms of that announcement from President Trump, 25% tariffs on all autos not made in the US. We've already seen Ford, Stellantis, GM falling after hours. It might not be a terrific day for Asia's car makers.
And also the Canadian dollar. We've already seen the Canadian dollar's weakened in early trading here as well. So it spreads across markets. So it's not just an equity market story. But as you say, we would expect to see some volatility in the big automakers here in Asia, and probably when European markets open later in the day. There's obviously some of the biggest companies like BMW, for example, Mercedes, they export a lot of cars into the United States, and most of those are not made onshore. So you would expect to see quite a lot of action there as well. But it also affects currencies. The euro is slightly weaker already. So it's across the board, really. The whole thing is very unnerving for investors. And there's an old saying in foreign exchange markets that confusion breeds contempt. Well, currently investors are very confused about what is going to happen now, what's going to happen next week, how things are going to play out. And when they do that, that means they become defensive. They become negative. They're being negative on equities. There's certain currencies they don't like, euro and the Canadian dollar taking the brunt of it for the time being. and they don't like what's happening in the yield curve in bonds as well. There's a number of ways this can play out, but clearly when investors are not feeling confident, they're going to be looking for ways to reduce risk, and this is how it is going to play out for some time here. The US exceptionalism is wearing out. It's probably going to get worse before it gets better, and that means that Bloomberg's running a big story today about M&A action is not playing out as people expected since Trump became president. And you can expect to see more of this kind of thing. US markets were priced very expensively when President Trump came in, and they're now beginning to unwind that, and there could be quite a bit further to go.
All right, Bloomberg's Mark Cranfield there. Still to come on the Asia Trade, we will be back live at the BOA Forum with Yale professor and former Morgan Stanley Asia chairman Stephen Roach. Plus, we're going to talk market strategies with UBS and BlackRock. Much more ahead. This is Bloomberg.
US President Donald Trump and top allies are struggling to defend criticism over the inclusion of a journalist in that Signal chat discussing war plans in Yemen. Defense Secretary Pete Hegseth and Director of National Intelligence Tulsi Gabbard claim that no classified information was shared in that chat.
I noticed this morning out came something that doesn't look like war plans. And as a matter of fact, they even changed the title to attack plans because they know it's not war plans. There's no units, no locations, no routes, no flight paths, no sources, no methods, no classified information.
But as the President National Security Advisor stated, no classified information was shared. There were no sources, methods, locations, or war plans that were shared. This was a standard update to the National Security Cabinet that was provided alongside updates that were given to foreign partners in the region.
For more, let's bring in Bloomberg's Michael Shepard. At the same time, we're hearing the White House also going so far as to say that this sort of concern is part of a coordinated effort by Democrats to sow chaos. But it's pretty hard for critics to be able to take the explanation that's been given.
Well, that's right, Heidi. And what we're seeing is that flooding the zone with defiance, as they have been able to successfully do during the preceding weeks of the administration when faced with criticism, is not working out quite so well this time. And the argument that there was no classified information shared during these exchanges that involved a reporter from The Atlantic, the editor-in-chief, Jeff Goldberg, really was not holding water for many in Washington, including the Republican head of the Senate Armed Services Committee, who had looked at the text and concluded that, yes, indeed, some classified material had indeed been exchanged on the platform and been exposed to somebody on the outside of this circle of national security trust. And to add to that point, The Atlantic itself published a nearly full transcript of the conversation among the officials to highlight the hole in the administration's argument that no classified material had been shared.
And Michael, you note the tone of defiance there. I guess that makes it unlikely that any heads are going to roll.
Well, for now, it doesn't seem like anybody is in jeopardy of losing their jobs, despite what is truly a significant intelligence blunder, according to many experts out there who have decades of experience in the national security field, and even members of the president's own party. We heard yesterday from Republican Senator Kelvin, who was aghast at the whole idea and really questioned about the discipline and wondered whether there should be more severe consequences. But for now, the response has been confined to lashing out at the media, questioning whether there was anything classified in nature being shared, and doing an internal probe run by someone inside the White House, rather than have a special counsel, as might be typically called for, to do an investigation, or have the FBI conduct an inquiry itself. But as the pressure grows, some of that course may ultimately have to change, because, as I said, the story is not really going away, and we're seeing the president and his advisors continuing to have to answer for it.
Mark Carney has said that this really shows that the Five Eyes need to look out for themselves, right? You've got to wonder what traditional allies is. I mean, we know how sort of, Europe is treated in this chat, but also adversaries might be thinking about this.
Well, and that's a great question, Heidi, because we've already seen this rupture in trust between the U.S. and its longstanding allies in Europe over the war in Ukraine, and how they have seen the Trump administration take this remarkable pivot toward Vladimir Putin, adopting some of Russia's talking points with respect to how the war started. And that it just adds to all the concerns that we're seeing related to this breach and exposure of sensitive information. And it will make those allies think twice about sharing what they know and what they might need to share with the U.S. And amongst themselves.
All right, Bloomberg's Michael Shepard there in Washington. Let's get some more news out of Washington now. U.S. Democratic Senator Elizabeth Warren says President Trump could fire Fed Chair Jerome Powell as part of a purge that she thinks may disrupt U.S. markets. Warren had opposed Powell's reappointment during President Biden's term due to his support for reducing financial regulations, but she told us exclusively she stands behind the independence of the Fed and other government agencies.
If he can just mow through the Consumer Financial Protection Bureau, it's a form of lawlessness, and all the power belongs to the king, that it suggests nobody is safe, not even the chairman of the Federal Reserve.
President Trump has reiterated its desire for the U.S. to annex Greenland as Vice President J.D. Vance heads to the island. Trump says Washington needs Greenland for international safety and security, and that it's essential for defensive and offensive postures. Vance's visit to Greenland, which was initially billed as a family outing, has been scaled down amid local backlash. The Trump administration has cut $20 million in funding for the agency responsible for chip export controls. The Bureau of Industry and Security oversees trade in U.S. technology. The 10% budget cut has drawn sharp criticism on Capitol Hill. Democratic senators say it threatens U.S. efforts to stay ahead of China in the AI race and compromises national security. More ahead on the Asia trade. This is Bloomberg.
Welcome back. Some of the top stories that we're watching in the AI space, and TD Cowen analysts say Microsoft has cancelled new data center projects in the US and Europe due to an oversupply of computers that power AI. They say the move reflects Microsoft's earlier decision to pass up on some new business from OpenAI. In a statement, Microsoft says it remains well positioned to meet increasing customer demand. Bloomberg's been told that OpenAI expects to more than triple its revenue this year to almost $13 billion. A source says that's fueled by the strength of its paid AI software. Corporate versions of ChatGPT have over 1 million users who recently added a $200 a month subscription option. Take a look at how we're setting up, particularly in the FX space, as we see that big move when it comes to the yen continuing to become under pressure, particularly with that dovishness in the comments we had from Governor Wader. The dollar also rising amidst the backdrop of auto tariffs.
If you look at the high-frequency data for the first couple of months, I think we actually had a reasonably good start. Obviously, we needed to prevent a replay of what happened before, that is the second quarter and the third quarter weaken again. And on that, I think the readiness of the fiscal and monetary policy to support the economy would be very useful.
It's PBOC advisor Huang Yiping speaking exclusively to Bloomberg at the BOA Forum. And let's get back to the forum now, where Stephen Engel's standing by with our next guest. Steve.
Yeah, that's right. Stephen Roach. He is the Yale Law School senior fellow and the former Morgan Stanley Asia chairman. Thanks, as always, Stephen.
Great to see you. Thank
Great.
you.
So you've been in China now a week. You were at the China Development Forum. You are now at BOA. What do you make of what the Chinese leadership is saying in the face, obviously, of a slowing domestic economy? Well, they've stabilized the domestic economy, according to some estimates, including Huang Yiping there, and also, of course, those external shocks. What do you make of it right now?
They want us all to believe that they're fine, that they're prepared for another round of external shocks, and they're very focused on internal demand as the offset. The key words, top hits coming out of the NPC and going into the China Development Forum and BOA are household consumption. That's music to my ears. I have been preaching the gospel on consumer-led rebalancing in China for, I checked my files a couple days ago, 17 years in a row. And my Chinese friend said to me years ago, keep going, don't let go. You know, one of these days they might get the message. And this year they've gotten the message. But what I'm worried about, Steve, is that their program is more slogans than substantive actions that really give me confidence that the consumer revival is at hand.
Yeah, it's always in the implementation and the devil's in the details, and it's really hard to wean yourself off that great cocktail of investment-led growth. And when we heard in Hong Kong a few months ago from Pan Gongcheng, the PBOC governor, he basically prioritized both still investment-led growth and consumption. Do you think it won't be enough?
Well, the trick on consumption, in my view, is you can generate a lot of jobs through rebalancing into labor-intensive sectors like services. You can raise real wages by moving poor people from rural to urban residences. And that generates growth, good growth in labor income. It needs to be faster, but you can do it. But then you have to convert that income into spending. And Chinese households want to save it because they're fearful of an uncertain future.
60% of their household wealth is tied to property, and we know what's happened to property.
Right. Well, it's not just that they've lost money in property, it's that their social safety net for health care and for retirement as they get older, and China's aging faster than any major economy in the world today, is inadequate. And so they are fearful of how they can make ends meet when they're older. And how do you convert that fear into confidence? That's a big stumbling block.
Do you feel a charm offensive, though, from Xi Jinping and the other leadership here through the CDF, through BOA and the like, and the meetings with the tech, the rehabilitation of Jack Ma, the meeting potentially tomorrow with foreign executives in Beijing, I assume, with Xi Jinping?
There is definitely a charm offensive going on. And we've seen this before, and they can be charming when they want to, and sort of not quite as charming when they want to as well. We'll see how the charm holds up on what we fondly are calling, at least what our president in the United States is calling, a Liberation Day next week, when tariffs go up around the world and there is retaliation that follows, and the risk of a global trade war increases. The charm could begin to wear off rather quickly in that event.
Well, you also compared Liberation Day to ground zero on globalization. Is that what's happened?
Yeah,
you really blasted yesterday in your panel this complacency about the threat to globalization.
Yeah, I was part of a typical panel that stressed the glorious outcomes of win-win globalization. And I reminded them that globalization is not like it's carved in the Ten Commandments. We had a powerful wave of globalization that began around 1880 and ended with the imposition of the Smoot-Hawley Tariff Acts in 1930 that led to a 60% plus contraction in global trade that contributed mightily to the Great Depression. And, here we are. 90 years later, and we are at risk of making a similar mistake with multilateral tariffs on all of our trading partners that we run deficits with. There are over 100 of them right now. And what the Trump administration doesn't understand, among many things, is that there will be retaliation when tariffs go up on the nations we run deficits with.
So, yeah, the Smoot-Hawley Act in 1930 came about 8 months after the bank crash, the Wall Street crash in October 29, and it lasted until 1939, the Great Depression. I've talked to a number of people here who say the U.S. potentially is heading in a similar trajectory towards recession. What do you think?
Well, I think, I'm not going to sit here and say that we're going to go into a depression, but I think the risks to the U.S. economy are tilting quickly to the downside for the simple reason is that Trump's policy uncertainty that he has injected, and he's doing it again overnight right now with autos and who knows what comes next, has taken our gauges of uncertainty to a record high. Uncertainty is the enemy of decision making. So businesses, when faced with uncertainty, will not make the big fixed cost decisions to hire new workers, to expand plants, and to engage in construction of new facilities to expand our productive capacity. So the uncertainty is really hitting the most dynamic segments of the U.S. economy right between the eyes, and that certainly raises the probabilities of recession later this year or into 2026 in the U.S. with collateral damage all around the interconnected, still barely globalized world.
Well, that's being reflected in the stock market of late as well. I think the Nasdaq was down another 2%. So the engine of the growth of the American economy has been reflected as a proxy in the market by the Mag 7. And what do you think what is your outlook for U.S. stocks throughout the rest of this year if this continues?
Well, I've learned as an economist that the last thing you want to do is call the stock market. But I did note and wrote about it that late last year, the so-called Mag 7, which Bloomberg has popularized with its proprietary Mag 7 index, which I follow hourly sometimes, had moved up to a market capitalization that was 34% of the total S&P market cap. I mean, it's an unbelievable concentration bet on 7 companies who are admittedly, in a perfect position to benefit from the revolutionary technologies of AI, but the market has valued them well in excess of any revolutionary impact they're going to have. And so, they corrected sharply. And, the DeepSeek shock effects of what's going on in this country are not an inconsequential part of that correction, and there's probably more to come.
Yeah, what do you make of the DeepSeek? It's on every official's lips right now. DeepSeek's and the other little mini dragons in Zhejiang province of AI. It's really given them a sense of confidence at a time when walls are building up abroad.
It's classic Chinese technology and imitation, where they take a great idea that has been put together by others, large language learning, and they've certainly played a role in developing and understanding the science as well. But, America, through OpenAI and others, were first movers. But it's a technology in the U.S. that requires an inordinate amount of data processing and energy to run the large language searching that is required. And the Chinese said, we can do the same thing. The algorithms to do the large language learning are not proprietary. We understand them. We've written some of them. But we can do them at a cost point that is so far below the American cost point, and the comparisons are staggering. 5 to 10% of the cost of the U.S. counterpart. So that challenges the whole dominance of American companies from the standpoint of the cost structure they have and the profitability they've been able to accrue, and the Chinese counterpart is quite extraordinary by comparison.
So, best case scenario, what do you think a Trump-China trade deal would look like? Where are the areas that potentially can be agreed upon, or there's concessions made? Do you see that happening, or is it more the worst case scenario?
Look, Trump is all over the place. You know, he wants to deal with the fentanyl issue. He wants to deal with, quote, unfair trading practices. He sort of rolled out the script that Robert Lighthizer wrote for him in 2018 with the Section 301 allegations of, you know, theft of intellectual property, forced technology transfer, predatory M&A activity. He wants everything and more. It's hard to know what kind of deal he's really looking for. He did phase one, you know, as a panacea. He called it the greatest deal in the history of deals. That came after, of course, the USMCA was also the greatest deal in the history of deals. China agreed to buy an incremental $200 billion of U.S. exports in 2020 and 2021.
And a review that's coming out April 1st.
Well, you know, I've looked at the studies. Chad Bone of the Peterson Institute, who went over to the State Department, you know, did a brilliant study in assessing how much of phase one accomplished. And he said, you know, the U.S. fell $200 billion short of hitting the $200 billion target. So, you know, it wasn't a great deal.
Yeah. Stephen Roach, always great to see you.
Thank you, Steve.
Hope to see you next year at BOAL, but we'll see on that one.
Look, I want to be here to celebrate your 20th anniversary in this wonderful spot.
Yeah, so that next year will be my 20th anniversary coming to BOAL. Thanks so much, Stephen Roach. Always great to see you. Back to you guys.
There'll be a party for sure. Our Chief North Asia correspondent Stephen Angle there in BOAL for us. His 19th year. Steve was talking to Stephen about the significance of DeepSeek, of course, and all of this AI exuberance. And on that topic, we're hearing that OpenAI is close to finalising that $40 billion Softbank-led funding round. We're hearing that the deal is set to value the company at $300 billion, including dollars raised. That's almost double its previous valuation of $157 billion from last year. Under this deal, Softbank will invest in an initial tranche of $7.5 billion, with a second lot of $30 billion later on this year. Investors include the likes of Magnetar Capital, Coatue Management Founders Fund, and Altimeter Capital Management in talks to participate. We have not had any comment from a number of these parties that are involved in this funding round, but this would be the largest funding round of all time, according to data from PitchBook, with that $300 billion value, including dollars raised there. Softbank hasn't commented either, but we have seen Softbank committed to a number of separate other AI-related projects as well. Billions to the Stargate projects, the Albaline Texas-based joint venture with partners including the likes of OpenAI, Oracle Corp, and MGX. We had previously reported at the end of January that $40 billion number as well, with that up to $300 billion value, but we're hearing now that they are getting closer to that finalised funding round. Well, coming up next, Charlene Barshefsky, who's a former US trade official, thinks that China's trade surplus is too big for the world. That exclusive conversation is next. This is Bloomberg. Well, the former US Trade Representative and Ambassador Charlene Barshefsky thinks that China is running a trade surplus that the world cannot live with. She spoke to Bloomberg in an exclusive conversation at the HSBC Global Investment Summit in Hong Kong.
Was it a mistake? Absolutely not. When you consider that 500 million people were brought out of poverty in China because of that economic change, when you consider that China became an important import source for the world and indeed the demand driver during the global financial crisis. Not a mistake when you consider China's contributions on the export side, provided demand signals were appropriately responded to, not as happening today. China has reverted to a highly statist economy, that China is non-responsive to demand signals, which is to say flooding the market with exports, and that China's basic development model, which moved from reform and opening to highly statist, is a model wholly dependent at this juncture on investment in manufacturing. not what the world needs right now. We don't have a supply problem in the world. We have a demand problem. And in that regard, China's contribution to demand, which used to be a positive, is now a negative, which is to say a dearth of demand in China because of structural and other issues in China. So China is exploiting manufacturing, suppressing domestic consumption, and expects that the world can live with $1 trillion Chinese trade surplus, which most certainly the world cannot.
One of the major pivot points this year has been this focus back among Chinese policymakers on boosting domestic consumption. I can't think of a better way to solve trade imbalances by getting that entire market buying again. Well, do you think that should be part of the consideration in terms of negotiations? That there is this exercise, while long it might take, for example, to get demand going internally?
I think that's absolutely a critical focus, and in the minds of some, the critical focus. So China has provided various plans to stimulate consumption. They're generally vague, and they generally have fallen short. It just came out with a new 32-point plan on this. We'll have to see how that is implemented ultimately and what the actual detail is. I do think there is finally a realization in China on the part of the leadership that indeed driving consumption does become very important. It's an important part of the equation, and the imbalance that exists in China's economy today can't be rectified until consumption increases.
I can't think of an exporting economy that will do a sufficient enough job, apart from China, to satisfy trade imbalances. In other words, are we looking for an export market that the world actually does not know? Like, what do we need to be asking China to do? What is its part in solving trade imbalances?
More important than China in solving trade imbalances is the United States. So the focus on tariffs in the United States, for many reasons, is largely misplaced. What the U.S. needs to do is bring down its fiscal deficit. It needs to reorient supply chains, not by itself. It can't do it by itself, but by, in fact, engaging with allies, partners, many others, to try and bring manufacturing back to the U.S. and other countries.
That's former US Trade Representative and Ambassador Charlene Barshefsky there. Now you can watch us live and you can see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions we talk about, and you can become part of the conversation by sending us instant messages during our shows. This is Bloomberg. Deal makers across Wall Street are facing a stark reality check after predicting a deals boom driven by the Trump presidency. Today's Bloomberg Big Take reveals that instead, deal making is essentially on hold as lenders become more selective about the transactions that they're backing. Senior equities reporter Bailey Lipschultz joins us now from New York. So Bailey, tell us how's the first quarter shaped up on the deals front?
It's shaping up pretty poorly, and it's tracking below what we had been expecting, below what even kind of the more skeptical bankers had been penciling in, whether that's some of the larger M&A that maybe people were expecting would be happening with Donald Trump back in the White House, potentially opening the floodgates, or within IPOs where people were bracing for private equity and venture capitalists to finally break the ice and get new companies back into the market. All things considered, it's very much a more tepid outlook when we talk to bankers, lawyers, and advisors across the suite of products and deals.
Are we seeing some of that sort of confidence whiplash around tariffs? Is that one of the secondary effects of all this uncertainty?
I think that's the biggest driver. When we talk to advisors, the question is, how can you strategize for a deal, whether you're the seller or the buyer, when any given moment a post or comments from the Oval Office can be force you to rethink what your value proposition is? Some of these companies will be coming out with kind of guidance before a board meeting on what deals could look like, what the price could be, and then before the meeting even happens, the entire kind of thesis around it or the thinking around valuation can do a complete 180 when you're looking at tariffs that are on again, off again. And as we track throughout the public markets, when stocks are gyrating and the VIX index for a good part of the month of March was well above 20, that forces people to rethink what that value proposition would be. And if you're sitting on a board trying to come up with a thesis on whether you should pull the trigger, the advice from lawyers, bankers, and some of these external advisors is that you need long-term visibility. And right now, that is the last thing people are getting from the White House around policy and obviously what's been pretty mixed economic data.
Bloomberg senior equities reporter Bailey Lipschutz there in New York. And speaking of that trade-related uncertainty, we'll be watching auto stocks trading in the session in Korea and Japan, set to open at the start of that session shortly, following, of course, President Trump's announcement of these 25% tariffs on autos not made in the US effective next Wednesday. This is the sort of pressure that we're expecting to see when it comes to some of these automakers. And it's interesting, we'll be watching for Hyundai in particular, despite, of course, being lauded for their US investment. It does seem like they would still be subject to this 25% tariff on all cars not made in the US, I should say, effective from April 2nd. We have heard that potentially reciprocal duties may be announced next week, but just a great deal of uncertainty there, as you can see in terms of the risk aversion that we're seeing in the session so far this Thursday morning in Asia. The market opens next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens, and it does like we're going to see that resumption of the sell-off in Asia, right? Risk sentiment really being taken a hit by these auto tariffs of 25% that go into effect next Wednesday. Possibility of sort of, reciprocal tariffs or some relief being announced. But again, it is this confusion over tariffs, not to mention, of course, the sort of geopolitical concerns over this ongoing signal chat debacle that is really preoccupying the news flow.
Yeah, that's not going away either, and that defiant tone from the White House over the signal chat story also just as deeply embedded. But in terms of tariff carve-outs, well, there could be something for China here regards the sale of TikTok. So again, waiting and seeing.
It is this sort of bedrock of uncertainty that investors continue to contend with, right? In particular, when it comes to, how much the primary economic effects, of which we haven't seen yet on inflation really, but also the secondary effects in terms of how corporates and households are kind of dealing with this degree of uncertainty and how that's going to play out for how much the Fed is going to be able to stay the course on its current trajectory. We are seeing that downside at the moment, as you can see, the Nikkei just coming online with the topics off by about 0.7% each. We're looking for that negative impact, of course, playing out in what should be a pretty straightforward way for a lot of the automakers, particularly the likes of Hyundai. Should be interesting. Of course, they had just a few days ago been complimented by President Trump in terms of the massive investment they've made in the US, but it does not seem like perhaps this sort of onshoring effort is necessarily going to get them exempt from these across-the-board levies on cars that are not made in the United States. Dollar yen at the moment pushing through that 150 handle. We have seen the dollar rising again as a bit of a haven bid with this tariff announcement, but also that dovishness that we heard from Governor Ueda in his testimony to Parliament yesterday could be at play there as well. Switching out the board to take a look at the Kospi, and we do know that there are going to be automakers, of course, that are heavily impacted there. I should mention across both the Japanese and the Korean markets, we should be watching for some of these AI and tech-related names as well, given that Bloomberg story saying that we're close to seeing OpenAI finalising a $40 billion fundraising round led by Softbank. So one to watch in the session today, Paul.
In terms of how we're tracking here in Australia, you've got the ASX giving up a lot of the gains that we saw on Wednesday, off about 0.5% at the moment. Most sectors in the red, although materials and energy not doing too badly. We've also got the Aussie dollar softening just a little. Of course, it's all about budgets and election here at the moment. We'll get the budget reply speech from the opposition tonight as they unveil cost of living plans to take to the election, the date of which could be announced, Haidi, as soon as tomorrow.
Well, Paul, our next guest thinks that investors should be prepared for a wide range of tariffs that will increase volatility. Joining us now from Singapore is Kelvin, Regional CIO at UBS Global Wealth Management. And, you know, Kelvin, we're having a bit of a chuckle on what we should start the conversation on, and it just has to be tariffs, and it feels like it's going to be tariffs for some time to come.
Absolutely. I think the overhang from the tariffs will likely be on the markets until the 2nd of April, until we get in detail what and where the tariffs will be implemented. The fear is that there will be a universal tariff on all markets at a determined rate. I think that will likely be the worst case scenario, but I think the chances of that happening appears to be slimmer after comments recently by the White House where the tariffs are concerned. So if there are basically a tiered rate of tariffs on certain countries and certain sectors, that I think the market may actually react a little bit more positively. But nonetheless, the tariffs will likely be an overhang on the markets until we get more details on the nuances where the implementation of the tariffs are concerned.
You talk about capital preservation strategies, and obviously we want to know about how you kind of protect against the downside risks.
That's likely to get trickier and trickier, because I think where the narrative is concerned, if the narrative of stagflation increasingly takes hold on the market, then obviously that's likely to actually be quite negative for all asset classes as a result of that. And in that kind of scenario, I think the only thing you can actually do is to actually manage your duration risk, which basically means that you have to reduce your equities and actually move into the very short duration government bonds, developed market government bonds. That, in a way, could actually protect and anchor your portfolio. On top of that, perhaps you can actually move into your private investments as well, like, for example, your private credit or private equity, and hold it on a medium to longer term basis, because if these are not marked to market on a daily basis, that in turn actually reduces the volatility on your portfolios as well. But that's not our view. We think that where the tariffs are concerned, we think that with the economy slowing down, that the Federal Reserve will continue to actually cut rates twice this year, once in June and once in September by about 25 basis points. And that in turn should actually be enough to actually lift equity markets for the rest of the year.
Yeah, well, let's take a look at how equity markets have been performing. I mean, specifically the S&P now heading for its first quarterly loss since September 2023. We're back below that 200-day moving average. But when you see that, do you think, okay, let's go shopping?
I think for certain sectors, definitely. We are still pretty positive on the AI and tech sector, and we think that the earnings growth where these sectors are concerned will likely be able to lift share prices over the next 6 months. But nonetheless, again, because of the current tariff situation, any risk appetite that investors have with regards to exposure to the tech sector will likely be quite neutral at this point in time, until we get further announcements, further details on how the tariffs are likely to be. And we're not going to expect that until the 2nd of April, unfortunately.
In terms of the AI tech story, are you at all concerned that things might be getting a little bit frothy there, that there are shades of the dot-com bubble, and maybe we're seeing a bubble in some of these AI-related names and around data center capacity as well?
Not really. We don't think that there is a bubble in the AI and the tech sector, actually, because we think that where the valuations are concerned, they're actually pretty well supported by your earnings growth, right? If you look at some of the stocks there, despite the massive increase in the share prices, the valuations have actually been pretty flat, which basically means that the earnings growth have actually been keeping up with the increase in the share prices. So we don't think that there is a bubble there. And of course, if we compare the valuations now with 2000, during the Nasdaq bubble, the valuations now are actually pretty tame in comparison, with very significant growth in earnings. And on top of that, these companies are actually profitable. A lot of them are actually very profitable with very healthy balance sheets as well. Where the data center is concerned, we think that this proliferation of AI demand with regards to the lower cost AI models, that in turn is likely to actually lead to a very strong increase in demand for data center capacity. So on a short-term basis, perhaps that could potentially be the narrative. But on a medium to longer term basis, we do think that demand for data center will definitely increase.
Kelvin, within Asia, India is one of your preferences, and I wonder, the recent surge that we've seen, do you think that is coming off the bottom or is it short covering?
I think it's a mixture of both, and I do think that on top of that, there is also a fair bit of rotation from some of the Southeast Asian markets here. You've seen the sell-off in Indonesia, you've seen the weak performance in Thailand, and that actually has resulted in some of the investors rotating into India as well. The Indian market, since towards the end of last year until recently, has not done well. And I do think that where earnings growth revision downwards is concerned, we're more or less at the bottom. With rate cuts coming through from the Reserve Bank of India as well, we do think that now India is actually starting to look a little bit more attractive, largely because the valuations have actually come off quite sharply as well. So India is actually quite an interesting market to look at from this point of view.
Taiwan is another one. Is that again the sort of AI tech play there?
Yeah, it is. If you like the AI and tech story, you definitely need to like Taiwan. But again, unfortunately, it has actually been caught up in the recent sell-off with regards to the tech names as a result of the introduction of DeepSeek in January, and of course with the recent announcements on tariffs as well. So we do think that on a short to medium-term basis, perhaps there might be some weakness there. But any weakness, in our view, is actually a good opportunity for us to actually accumulate some positions there, because on a medium to longer-term basis, again, the tech and the AI names actually look really attractive in our view.
Kelvin, before we let you go, you also favour gold. How much more upside do you see from here?
Absolutely. The fact that gold prices are near its record highs is largely because of three factors. One, uncertainty, and we're getting a massive amount of that recently. Two, the dollar weakening in the last couple of weeks. And we do think that that is a trend that's likely to continue, because your Eurobond news have actually shot up as a result of the massive sell-off in German bond news, in German bonds recently as well. So that will likely support a further weakening of the dollar. And on top of that, you basically have central bank buying in bulk, and that has not changed. That in turn basically means that the demand is there, and of course gold supply is not coming up very strongly. So this deficit in demand and supply will likely actually keep gold prices very well supported over the medium term. So we do think that gold prices are likely to actually breach the $3,200 per ounce level.
All right, Kelvin Tay, Regional CIO at UBS Global Wealth Management. Thanks so much for joining us. Let us take a look at how auto stocks are doing in Asia. We're waiting for this one, and it's panning out very much as we anticipated, seeing losses for all of those big names there to the tune of around 2 to 3%. Hyundai is an interesting one. That's off 3.8%. This is despite yesterday celebrating the opening of a brand new $7.6 billion electric vehicle factory based in Georgia. Yes, that is the Georgia in the United States. So it appears even making hefty investments in the US, not enough to spare that stock from fear around that 25% tariff on autos announced today by President Trump. Heidi.
Does not seem so. Well, coming up, a PBOC advisor tells us that Beijing is ready to deploy further stimulus if the economy needs it against the backdrop of the Trump tariff threat. We have that exclusive conversation next from the Boao Forum. This is Bloomberg.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
All right, President Trump there talking about that 25% tariff on auto imports. Of course, that's just the entree. The main course yet to come on April the 2nd. Our Australia government reporter Ben Westcott's been following this story for us. Ben, Australia so far not been spared from the US by the US, despite its position as an ally, as running a trade surplus. What more is coming down the pipe, not just for Australia, but for other Asian nations?
Yeah, well, I mean, you mentioned just there about before the break about how Hyundai's stock price has fallen. And I mean, the reason behind that is because they are the second largest importer of cars to the US outside of Volkswagen in Europe. So obviously these tariffs are going to affect nations across Asia in a big way, including Australia. Both Japan and South Korea are huge importers of cars to the US, forms a major part of their economy. And in addition, we've got Canada and Mexico over in North America as well. As far as Australia is concerned, looking towards that April 2 deadline, yesterday I asked Treasurer Jim Chalmers whether or not they'd been given any assurances yet by President Trump that Australia would be part of the very limited exemptions from that Liberation Day Trump tariff announcement. He said there has not. He said they've been told so far nothing. So no news yet on whether or not Australia will get a treasured exemption from those Liberation Day tariffs.
And an exemption might only come with a deal, right? We know that Trump loves that, and he said that with respect to potentially TikTok and some sort of exemption for China. Take a listen.
I'm worried about our country more than anything else with respect to TikTok. And China is going to have to play a role in that, possibly, in the form of an approval, maybe. And I think they'll do that. Maybe I'll give them a little reduction in tariffs or something to get it done.
Ben, this seems like it would come down to the sale of TikTok to an American company, but I guess anything is possible in terms of what sways the president.
Oh, absolutely. And this is something that Trump's been talking about for quite some time, the goal to get TikTok sold to a US company. I think there was a lot of relief inside TikTok initially at his win, given that they had very successfully convinced him of the value of TikTok to America. But it has turned into something of a double-edged sword now that Trump believes that it's so useful that he would like to see it in American hands. Now, that looks like something that he could use his tariffs to potentially put a bit of pressure on TikTok to hand it over. But we'll have to wait and see. I think as far as Australia is concerned, Australia had previously tried to use critical minerals as a source of deal making with the US, maybe promising a larger chunk of critical minerals for America if they gave Australia a tariff exemption. It didn't convince Trump to not put a steel and aluminum tariff on Australia, however. So it remains to be seen whether or not those April 2 tariffs will be any different.
Ben, we need to talk about Signal. Of course, Pete Hegseth, including a journalist on that Signal chat, which discussed strikes on Yemen. Australia is, of course, a member of the Five Eyes, a trusted long-time ally of the United States. Seems to have been a diplomatic silence out of Canberra so far. Have we heard anything at all?
Yes, yesterday, Deputy Prime Minister Richard Marles said that he would not be using Signal to be communicating confidential information with his colleagues, and even made a joke about him checking his own Signal chats to see whether or not there are any journalists on them. So a bit of light-hearted ribbing, maybe, from the Deputy Prime Minister, who's also the Defence Minister and has met with Secretary of Defence Pete Hegseth. So far, there has been no moves in Australia to limit intelligence sharing with the US, and there was following the election of the Trump administration. But there was some pushback following those steel and aluminum tariffs that came in just over a week or so ago. It'll be interesting to see if there is more tariffs during the Liberation Day or more ructions between Australia and the US, if things like intelligence sharing could become more of a political issue. But obviously that's all still up in the air at this stage.
Now, we did hear from Mark Carney saying that the Five Eyes need to sort of watch out for themselves in light of this, right? Australia government reporter Ben Westcott there, as we continue to see that fallout on the Signal chat issue. Well, an advisor to the Chinese central bank says the economy has gotten off to a good start this year, but authorities are prepared to deploy more stimulus if growth loses momentum. Huang Yiping spoke exclusively with our Chief North Asia correspondent Stephen Engel at the Boao Forum.
The government has made it very clear that if there is a need, both the fiscal policy and the monetary policy can step up. That, I think, is very clear. So basically, it will be data-driven. If the economy is strong, then perhaps we can just go with it. But if the economy shows signs of softness, then both the fiscal and the monetary policy still have enough scope for further expansion.
How would you assess it right now, coming out of the National People's Congress? There seemed to be a lot of talking about green shoots of confidence, but the property market in the first couple of months was still quite weak. Consumer demand still quite weak. And they didn't necessarily announce specifics on easing or further large fiscal outlays other than long-term bonds and the like. Do you see right now the need for further easing?
Well, I think that we need policies to be ready if we need. As I said, it's a data-driven decision. But what we saw was after the end of September last year, the policies turned around and the numbers picked up. So the fourth quarter was much better than the third quarter. If you look at the high-frequency data for the first couple of months, I think we actually had a reasonably good start. Obviously, we needed to prevent replay of what happened before, that is the second quarter and the third quarter weaken again. And on that, I think the readiness of the fiscal and monetary policy to support the economy would be very useful.
In the first Trump trade war, we saw, I don't want to use the term weaponization of the yuan, but we did see the weakening of the yuan, some 11% over 2 years. This time, the PBOC has kept it very steady and stable. Is that sort of weakening the overall easing buffet that is at their stable? Should they weaken it further?
Well, there are many different arguments. If you weaken the currency, that might be useful in the short term for exports. But at the same time, as you know, exchange rate also has a big impact on the capital flows. It has an impact on trade flows, but also on capital flows. I think for the policymakers, you have to balance, trying to weigh which is more important. If the currency is weaker, and hopefully if it gets lots of exports, then it's good. But it's possible that you might not get a lot of exports while you weaken the confidence on investors. So I think, in my view, is that, our exchange rate is still managed float. So management is still part of it. At the end of the day, you need to balance the likely impact on different parts of the economy.
What do you think the policy response so far to the external shocks? Has it been successful enough? We don't know what's coming on April 2nd. There could be further tariffs. Is China going to be able to weather this external shock?
Well, China will be able to weather the external shock. The question is how big will be the shock. But that's also in line with the policy direction going forward. Exports will be important, continuously to be important. The question is, can China continuously rely on exports to drive Chinese growth? That's why the priority actually now is more on expanding domestic demand, particularly domestic consumption.
PBOC advisor Huang Yiping speaking exclusively with our Chief North Asia correspondent Stephen Engel. We have more ahead on the Asia trade. This is Bloomberg.
Well, Bloomberg has learned that OpenAI is close to finalising a $40 billion funding round led by Softbank. The deal is set to value the company at $300 billion. Bloomberg Senior Executive Technology Editor Tom Giles joins us now from San Francisco with the details. And Tom, we've been tracking these discussions for a few months, but if this is pulled off, this is going to be the biggest VC funding round in history.
That's right. We did know that this was in the works. What we've revealed today is more detail on timing. It's coming soon. They're very close to finalizing these discussions. We've gotten some detail on who some of the investors are going to be, aside from Softbank. We've got Founders Fund, we've got Magnetar Capital, Co2. So the other players that are going to be part of this mega funding round, which, as you pointed out, PitchBook has identified as the largest ever for a venture capital-backed startup. It's a monumental funding round, biggest ever. So we've got new details on who some of the players are going to be. Who are these people who are going to have a stake in this company that is just seeing some tremendous growth?
Tom, can you tell us a little bit more about those names, perhaps, and whether or not this represents a good investment, because revenue seems to be tracking reasonably well at OpenAI?
Yeah, that's right. So Altimeter Founders Fund, which of course is closely associated with Peter Thiel, we earlier today we broke news on their expectations around revenue that it'll more than triple in 2025 to about 12.7 billion. That's up from 3.7 billion in 2024. They're looking at 29.4 billion in 2026. So this is a company that continues to grow at a rapid pace. As you know, these generative AI tools, OpenAI is charging its customers for them. So these are things that are helping you not just change the way we work, but change the way we code in particular. They're being used by a widening circle of customers, and they're changing the way we live and work and search and obtain information. People are willing to pay for them. Now, it's notable we do not have exactly what where they are in terms of profitability or loss making. Remember that creating these LLMs, maintaining these systems, these platforms, costs a lot of money. So what we're going to continue to try to do is get you, our readers, and our viewers, information on what the losses are, where margins are, what kind of profitability or lack thereof there is. That's a huge, outstanding question at a time when the cost of building the data centers, investing in the infrastructure that is needed for these platforms, is a massive outlay of capital.
All right, Bloomberg Senior Executive Technology Editor Tom Giles there. Let's get some more news in the AI space now. TD Cowen analysts say Microsoft has cancelled new data center projects in the US and Europe due to an oversupply of computers that power AI. They say the move reflects Microsoft's earlier decision to pass up some new business from OpenAI. In a statement, Microsoft says it remains well positioned to meet increasing customer demand. Alibaba's released a new AI model in its Qwen series that says it can process audio and video on phones and laptops. The company says the model could build AI agents that can assist visually impaired people, among other applications. It's touting what it calls a particularly high performance in speech understanding and generation. All right, let's take a look at how futures in Europe are opening. We have stocks futures currently in the red, the tune of about 0.5%. DAX futures a little bit softer as well. It's going to be interesting to see how European car makers perform following that announcement from President Trump of 25% tariffs on all non-US made autos. Take a look at currencies as well. We may see them move in the wake of that tariff announcement as well. More ahead on the Asia Trade.
I would be wary of assuming that the impact of tariff increases on inflation will be entirely temporary, or that a look-through strategy will necessarily be appropriate. I would be especially vigilant about indirect second-round effects on inflation.
You know, there's been four big trends in the last 35 years or so. Lower rates, deregulation, technology, and the last, globalization. Certainly globalization is being redefined right now.
St. Louis Fed President Alberto Maselem and Apollo Global Management President Jim Zalta there. Take a look at how we're tracking bonds at the moment, given all of this sort of broader tariff uncertainty, as well as still questions, of course, over China's economic recovery there as well. We did hear from the PBOC, one advisor saying that they're staying ready to deploy if the economic growth momentum starts to slow. We are seeing bond markets drawing really a rush of issuers at this point before we see the impact of Trump tariffs hit on that April 2nd deadline next week, Paul.
Yeah, well, we're joined by Navin Saigal, BlackRock's Asia-Pacific Head of Fundamental Fixed Income. Navin, thanks for joining us today. And I just want to pick up on that remark that we heard there from Alberto Maselem, really echoing what we heard from Raphael Bostic earlier this week. Some warnings about the risks around tariffs versus inflation. How do you see these risks playing out?
For having me on the show, and certainly agree. You know, the word unprecedented has been used a lot in the last 5 years, and I think this is, again, an unprecedented time when it comes to policy uncertainty. there's been a chart going around, and I actually posted it on my LinkedIn account, of how U.S. trade policy uncertainty has hit, multi-decade, basically all-time highs. And this is an interesting time because, on one hand, the best way for investors to tackle uncertainty may be to hold cash. Nobody can blame you for putting your money into a 4.5% money market account. But honestly, I think that is not the best opportunity for fixed income investors today. The best opportunity is that today you are able to earn about a 6+% income stream through a diversified, fairly low risk portfolio of bonds. That is where we think investors should sit to ride out this policy uncertainty, not just from the US, but also there are developments in Europe around the German fiscal program going forward, China around the economic rebalancing. And you can earn about 0.5% a month of income sitting on a portfolio of a 6% yield and wait to see how this plays out and deploy your cash then.
Can you sketch out what that portfolio might look like? Because I know you consider Asian bonds to be a good diversifier in these interesting times.
Certainly. Almost anywhere you look in fixed income these days, you can earn about a 1.5% to 2% real yield. And we view real yield as basically the compensation you're getting, or the margin of safety you have for being wrong on inflation. There is a lot of inflation uncertainty as well, but with a 2% real yield, that's a comfortable place to be. Now, this opportunity set, as I said, it's through all sectors and it's global. We think that the desynchronization of economies, with the epicenter being the Pacific Ocean, the economies on the left and the right, basically the US and China, have become very desynchronized, such that their growth, inflation, and monetary policy trajectories have diverged. Now, this started before COVID due to structural factors like immigration policy, demographics, geopolitics, now trade policy. But it was accelerated through COVID because of the stopping and starting of the economies, the various fiscal policies that were used to counteract the effects of COVID. And now on the other side, what we have is a very uncorrelated bond market in Asia to that of the US. That correlation is almost zero. And so there are places in Asia that we like because they have that 1.5% to 2% real yield. They actually have about a 6 to 7% nominal yield as well. And this fits very nicely into a global portfolio of bonds with that 6% income stream.
What about the picture when it comes to opportunities in Japan, given the divergence in where that economy and that central bank is headed?
Yeah, Japan is a truly unique one because in Japan, I would say the kind of the monetary policy cycle, the fiscal cycle, those are again desynchronized from the rest of the world. Certainly in monetary policy, we can see that the BOJ has just embarked on this normalization path. And we think that the normalization can continue. I mean, I was just talking to a Japanese colleague who was visiting last week, and we were discussing how for a Japanese consumer, a Japanese man on the street, it feels pretty good to have a bump in your paycheck, to have a wage gain after a long time of flat wages. And then you get annoyed when you go into the grocery store or any store for that matter and you see prices are higher than what they used to be, or restaurant for that matter. But this is actually exactly how the wage price cycle works, right? You get a bump in wages and it flows into prices, price increases, and it flows back into higher wages. So I think the BOJ will feel and will see evidence that the path to normalization is there. Inflation is sustainable, at least cyclically sustainable. And so we do think that the market is being fairly conservative in its pricing of the hiking path. So we don't mind being short Japanese front-end rates. At the same time, I will mention that Japan has one of the steeper yield curves amongst developed markets. So we're actually okay buying the long end of the Japanese yield curve, because when you swap that back to dollars, especially when you swap that back to dollars, that does fall into this 6 to 7% yielding bucket that I mentioned.
We've seen some moves on the longer end for China bonds after the PBOC's MLF tweak earlier this week. But I do wonder, given that both economic momentum is starting to pick up, but we're also yet to see the full force of trade tariffs for China, where do you see the opportunities for that market?
I think in China, this year, coming into this year, the whole market was basically long the China fixed income complex. And I think for China, when you see the market all on one side of a trade, the way to play that is to take the other side. So we have been playing Chinese rates from the short side. Now with this backup, I think there is more two-way risk, and it's easier to kind of play from the long side as well. But generally, I think to facilitate this rebalancing, we will need to see a generally easier path when it comes to monetary policy and financial conditions in China. That I think is the structural trend. And I think it's a challenging time to rebalance the economy towards consumption. You need consumption to grow faster than the growth rate of the economy. And to facilitate that, it will require a policy shift. So we are also eagerly awaiting the developments that come out of China from the policy front. And again, I think when you have any uncertainty, the opportunity set to earn this 6-7% income stream in global fixed income is an incredible one that we should not waste.
Navin, before we let you go, we do have fourth quarter US GDP coming out tomorrow, seen holding steady, 2.3%. Do you have any recession concerns here?
Not recession, no. We think that there will be a moderation, perhaps even a slowdown. And I'll give you, some numbers. GDP going from 3%, which is kind of, to use rough numbers, what it was last year, to 1%. That is a haircut of about 2%. That could be painful and it could feel recessionary, but at the end of the day, at 1%, the economy is not actually contracting. And that's okay. 1% GDP, 3% inflation, 4% nominal growth rate, that's okay for most fixed income, for most credit spreads. On the other hand, in the 2010s, if you had a 2% haircut to growth off of a 1.5% to 2% growth rate, then you are at least flirting with recession, if not outright contracting. So I think that's the difference. It's the starting point. We're starting from a pretty strong point. There will be some moderation, but I don't think fixed income investors need to be very concerned.
Navin, really great to have you with us. Navin Saigal, who's the BlackRock Asia Pacific head of fundamental fixed income there. We're hearing now from Japanese Prime Minister Ishiba talking about, in reaction really when it comes to these Trump auto tariffs, that there are actions in response to US tariffs and they are possible actions, reiterating that Japan is asking the US for an auto tariff exemption and they'll be considering the most effective response to these recently announced US tariffs. And we have seen car maker shares in Japan, as well as the rest of the region, slumping after President Trump slapped that 25% tariffs on all auto imports. Concerning for a lot of these markets, a lot of these automakers, I should say, that have key markets in America and sales now being sort of endangered. It's pretty hard to see any upside when it comes to the broader Japanese markets, given that the most heavy weighting for stocks there, Toyota, is down by 0.5%, but we are off those session lows of as much as 4%. Honda getting more than half of its revenue from North America down there as well. Nissan also falling, as well as Mazda. By far the worst performance when it comes to the Topix index. In Japan, like a number of traditional US allies have hoped for and sort of lobbied for trade tariff exemptions alongside the likes of Australia, of course, but have not to date received them. We're still ahead on the Asia trade. Chinese electric vehicle maker Xpeng shares its plans to ramp up global expansion as competition in the space accelerates. We'll be hearing from the company's president next. This is Bloomberg.
Chinese EV maker Xpeng says it's planning to ramp up its global expansion as rival BYD charges ahead. Vice Chairman and Co-President Brian Goose spoke to us about their plans, including where they're looking to invest in factories and other infrastructure.
Our focus has been Europe, Southeast Asia, and now growingly in Middle East as well. For us, I think the globalization is not just making cars available for these markets to sell. We see actually, we requires much stronger, commitment and investment locally. That's why we're actually building infrastructures. For example, we are now in process of building our R&D centers in Europe, in the German region. We're also looking at, as you mentioned, local production plans. For example, we recently announced a plan to jointly look at local production in Indonesia. And also, in terms of charging, we also actually are starting to think about local charging investments as well. So all of that, I think, is required to really build a robust global business. We actually have already entered over 30 countries in the world, and we have plans to enter dozens more. And I think with local investment, local focus, and local capabilities with the teams on the ground, I think that will give us a better chance of success.
Are there any markets where you're not yet producing cars where you're thinking that a localization push might be worth? I mean, in other words, what is the next market that you're potentially eyeing for that production, shifting production?
As we look at long term, I think if you have an aspiration to be one of the leaders in core local markets, you have to be local. And that's why I think for all the core markets, we think, whether there is a need for localization, I think ultimately we need to do it. For example, in Southeast Asia, as mentioned, Indonesia, maybe in other countries as well. Maybe in Europe, there's one of the large regions for EV sales. Maybe local plans and infrastructure is also required. Even in Latin America, some of the large markets require local investments. I think all of that, are things that we're monitoring closely.
Any Latin American markets where you see particular opportunities? Obviously, a really enormous market.
Well, countries like Brazil and Mexico are very big. In fact, I see also very good reception to Chinese EV products locally. So I think those are definitely core markets we're going to spend time focusing on.
Xpeng Vice Chairman and Co-President Brian Gu there speaking to Bloomberg's Rebecca Chong-Wilkins. We are less than an hour away from the market open in China, and this year's big rally in tech stocks is on pause. Investors will be looking for more clarity on global economic policies, concrete signs of core business improvement to get things rolling again. Our equities reporter April Ma joins us now. So we have seen significant profit taking on the Hang Seng tech space. Is that set to continue?
I would say that maybe the profit taking might see a pause. I think the fact that the Golden Dragon Index actually rose, or it was slightly stronger than the other gauges in the U.S., would probably give a little bit of more confidence to investors in this time zone. I think that still investors were a little bit harsh taking apart these tech companies' earnings and scrutinizing for any just signs of negativity to take profit out of the table. I think some of that risk-off may persist in the coming sessions just ahead of all this tariff uncertainty. But even if so, I think that we have a pretty strong support line from the September lows through now that could provide a bit of a lift.
So what else might be investors waiting for as that early DeepSeek effect starts to wear off?
Yeah, so the sentiment I'm getting is that the big question mark around all this cash that's being thrown at these models is when will this start to bring money in? When will this transform or translate into cash flows and paying users? I think that's still one of the key overhangs about this tech story. Another issue is the fact that, on the macro level, China's consumption still isn't back completely to those like go-go years. So that's also going to cloud the outlook a little bit. But yeah, I think overall it's just like, where is this AI push going to start to show up in earnings? But on the plus side, China's always been known to be have quite an edge in terms of application of technology, as opposed to the organic development of the technology. So I think that in the coming months, I'm pretty optimistic about the fact that we'll be seeing more applications, both in software and in hardware. So that might be the next catalyst coming forward. Yeah.
Do we see investors viewing H shares versus A shares through different prisms?
Yeah, I think the view is still pretty divided. I mean, the tech play on A shares has been really crowded in the smaller stocks, say the CSI 2000 index. So those are stocks that are not going to have the earnings support that the bigger HS tech peers are going to see, because they have other businesses that they can rely on. But that said, I think that that a lot of the global investors are also eyeing A shares with more intensity, because simply the fact that H shares have gone up so much while many of the A shares have stayed mostly in place. Yeah.
All right, equities reporter April Ma there. Well, Apple CEO Tim Cook has visited China's artificial intelligence hub, Hangzhou, and the home of AI sensation DeepSeek, also tech giant Alibaba. Let's get to our China correspondent, Minmin Lo, for more. So, Minmin, tell us about the significance of this visit.
Yeah, so Tim Cook made a visit to Hangzhou, where he visited the Zhejiang University and hailed what he called the next generation of developers, because this is a university that has churned out alumni like the DeepSeek founder Liang Wenfeng and PDD founder Colin Huang. And Apple has donated about 30 billion yuan or $4 million to the university in partnership to support this mobile app innovation competition and to provide technical and business training for students. So in a way, it is a bid by Apple to show its continued commitment to this very important market, where it has seen shipments of iPhones in the last quarter down about 25% amid this intense competition from the likes of Xiaomi and Huawei. And Tim Cook has been in China since early this week. He was in Beijing for the China Development Forum, where he got a chance to sit down with the Chinese Commerce Minister Wang Wentao. And Wang had signaled that China is willing to welcome more investments from Apple, for Apple to continue to deeply integrate into the Chinese economy. Wang also signaled that equipment upgrading program, the subsidies, will cover foreign products like Apple's iPhone. So in a way, it is a mutual form of engagement from Beijing's side to woo these foreign investors and companies to stay in China, and also for Apple's Tim Cook to show that they are here for, with a stake in the country, and they're here to stay for the long term despite that uncertainties globally.
Meanwhile, Alibaba has a new AI model of its own. This one can process text, pictures, audio, and video.
Yes, this is the latest iteration of Alibaba's AI model, and it has been unveiling these new developments at record speed this year. Alibaba saying that this new model will be able to help build an AI agent that could help the visually impaired to navigate their environment with these real-time audio descriptions, because this model has very strong capabilities in speech understanding and speech generation. And again, Alibaba has committed to investing $50 billion over the next 3 years in AI infrastructure. But as what April said earlier, the company is also intent on partnering with companies for real-world applications that could bring in that cash flow. And that their latest deal is with BMW to help create that AI cockpit, a personal assistant in these cars that are being built and produced in China that will roll out next year. The personal assistant in these cars will help you to plan trips and to offer parking and nearby restaurant recommendations. And it is also a win-win for BMW, which has been seeing dwindling market share. Its sales was down about 13% last year, again amid this intense competition from local rivals, because this is a market where software increasingly is that important differentiator in the EV space. And BMW is joining a number of foreign companies like BMW and Volkswagen as well to seek these tech partnerships to get the tech expertise to stay ahead of that race.
Bloomberg's China correspondent Min Min Lo there. More ahead, do stay with us. This is Bloomberg. Let's take a look at some of the top global headlines that we're tracking this hour. And Canadian Prime Minister Mark Carney says US tariffs on autos are a direct attack on Canadian workers, and his government will soon respond. He also says Trump's action is a violation of Canada's trade agreement with the US and Mexico. Carney will convene a cabinet meeting on Thursday focused on trade, while also suggesting Trump should speak with him about the actions he's taken. The Seoul High Court has cleared South Korean opposition leader Lee Jae-myung of breaking election laws. The ruling overturns a lower court's decision which found Lee guilty of making false claims in 2021 while campaigning for the presidency. The acquittal could boost Lee's chances in any election triggered if President Yoon Suk-yeol's impeachment is upheld by the Constitutional Court. Former Brazilian President Jair Bolsonaro will stand trial on allegations that he attempted a coup following his 2022 election defeat. A Supreme Court panel unanimously voted to accept criminal charges against him. Bolsonaro has denied wrongdoing and accuses the Supreme Court of holding a personal grudge against him.
All right, time to check some of the stocks to watch when markets open in Hong Kong and mainland China. Alibaba, Baidu, Tencent, JD.com, some of these names could see some upside. We have, of course, just told you the story about Tim Cook paying that visit to Guangzhou as well. We've seen AI-related names coming under a little bit of pressure in the US. However, some concerns over data center capacity and whether or not there are signs of frothiness on AI stocks as well. Let's take a look at how US futures and China futures are shaping up. It was a bit of a rough session for US stocks. We've got S&P futures currently to the downside by about 0.1%. A little bit of softness for Taiwan and Chinese futures as well. Although we did have a suggestion from President Trump that there could be some sort of deal for China on lower tariffs if there is support for a TikTok sale. All right, that is it from the Asia trade. Markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show up next. This is Bloomberg.